Hello viewers, welcome to our investing series part 4 and today's topic is index investing. We were discussing about mutual funds in the previous video. I have missed just one topic in that, so I want to cover that topic first before we actually start with index investing. Okay, in mutual funds we discussed many classifications like debt funds, hybrid funds, equity, gold, ELSS, all that. Within equity, there are again sub-classifications: large cap funds, mid cap fund, small cap, multi-cap, flexi cap. So there are many classifications. Earlier, there was a problem in which a particular stock can be identified as a large cap by one fund house, whereas another fund house can treat the same stock as a mid cap. So from investors' point of view, the things are like not in sync between fund houses. So to remove all this ambiguity, what SEBI came up with is, they will take the market cap for an average of last 6 months. That is like from Jan to June and July to December. So every 6 months, they will take the average market cap and prepare a list in the descending order of market capitalization. In that list, the top 100 stocks are classified as large cap. Next 150 are classified as mid cap, and rest of all the stocks they classify as a small cap. So when you select a large cap for investing, then the fund manager is restricted to invest only in the top 100 stocks. He cannot go beyond that. So this is done by SEBI to bring uniformity across all fund houses. And there is a website like Association of Mutual Funds of India. They create and publish this list every 6 months. I will provide link in the description of the video where you can actually go and check and download the list of stocks for your own reference. Okay, I think this is the point that I wanted to cover. Now let's get started with our today's topic. Before that, I would like to talk about this book, Art of Stock Investing, written by Manikandan Ramalingam from BSc to NSc. This book is for long-term wealth creation by selecting the companies that are making profits year after year. So this has very simple rules where one can filter down stocks based on like 4 criteria. And this is a very quick read. You can finish it off in 60 minutes or so. Even if you are completely new to market, you will be able to get hold of the content in this book. Okay. Continuing with index investing. What is index investing? Say let us take Nifty 50. It has 50 different stocks covering various sectors, and each stock has its own weightage. So if you want to get the returns from the index, what you can do is you can invest your capital into the same 50 stocks in the proportion of their weightage. I mean the quantity you should buy as per the proportion of the weightage. But it is difficult for you to do individually by investing directly onto the 50 stocks. So never try to do that. Instead, you can invest in index funds. There are many fund houses who provide index funds. So you can select any of the fund house where the expense ratio is less, and then you can invest your money. This is passive investment, not active investment. You need to understand what is the difference between passive and active. In the actively managed funds, like you take any large cap or mid cap, anything other than index funds, all are actively managed funds. It is up to the fund manager's decision which stock to buy, when to buy, and when to exit, how much allocation that he has to do. It is the decision of the fund manager. So there are a lot of work for the fund manager, and the returns that you get depends purely on the decisions made by the fund manager. Since there is a lot of work, the expense ratio of those funds will be higher. if you take index funds, what is the role of a fund manager here? They just have to buy the stock which is part of index and sell the stock which is removed from index, and NSE will do that once in 6 months. Maybe 1 or 2 stocks will go out and they will be replaced by another set of stocks. How much quantity to buy, everything is already defined by the exchange for that particular index. So they will have to allocate the money in the same proportion of the weightage. So fund manager's intelligence doesn't generate returns here. So the cost is very low and it is passive. So for long-term wealth building, index investing is one of the very good options. This is not true in the countries like Japan, because when you see financial news, you will see some headlines which will say Japanese Nikkei climbed 32-year high or 30-year high, meaning their index, main index, the high which was made like 30 years back, they are reclaiming that only now. So in those economy, you shouldn't do index investing. You should do index investing in an economy which is growing like our economy. So I will show you some historical returns of our different indices. When you understand this, and also you need to know, most of the fund houses, they benchmark their returns against index. So they wanted to try to generate higher returns than an index. If they are not able to make higher returns, then they are not doing any better job. Instead, investors can just go for index funds rather than going for actively managed different categories of mutual funds. Okay. I have selected 5 different funds: Nifty 50, Nifty Next 50, Nifty Bank, also known as Bank Nifty, S&P 500 and Nasdaq 100 are from US. So I have selected the current value sometime this week, and I have captured the historical values like what it was 20 years earlier, 15 years earlier, 10 years earlier and 5 years earlier, and I have calculated the returns. So don't take the Bank Nifty returns for 20 years because that is when the index was introduced, so the returns will seem higher. But you can find Nifty 50, Nifty Next 50 on a 20-year period has generated higher returns like 13%, 14%, which is way higher than what you can get in your fixed deposits, in your EPF, PPF, National Pension Scheme, all. And the risk is very, very low in index funds than any other mutual fund, because the index is rising in our country. Because it's a growing economy, the index will keep going up. Another statistics to note here is 55% of adults are invested in US, whereas in India, only 4% of the total population are invested. I'm not comparing adults in the US versus adults in India because I don't have that statistic. I can find only the total population wise in India. So there is a still lot of scope, huge untapped potential in our market. When many people will come into these financial instruments for their savings and wealth creation, we are likely to go further high from the current levels. Okay, you decided to invest in index funds. How to go about it? There are 2 types. One, you can actually go to any mutual fund platform like Zerodha Coin, Grow, Paytm Money, ET Money, or any platform that offers direct mutual fund. Don't go for regular fund, direct mutual funds. You can select, first you have to decide which index you are going to invest. Once you have selected the index, compare the expense ratio for the particular index fund across the fund houses to find out where the expense ratio is less, and you can select that fund house because the returns are going to be almost same across all the fund houses. Then why you have to pay a higher expense ratio? And Motilal Oswal has S&P 500 and Nasdaq 100 index funds in case if you prefer to invest in US indices. Recently, Mirae Asset has launched FANG Plus ETF, where they focus only on the top 5-6 companies in US. If you prefer to buy directly from the trading platform like the exchange traded funds ETF, for Nifty 50 you can use Nifty Bees. For Nifty Next 50 you can use Junior Bees. Nifty Bank you can use Bank Bees. For Nasdaq there is an ETF N100. Why I am selecting these 3 Bs like Nifty Bees, Junior Bees, Bank Bees is they are the very first ETFs launched in our country and the liquidity is higher in those 3 ETFs when compared to rest of the ETFs for the similar funds. Okay, so I have explained the different points about index investing. In the next video, we will start with equity investing. If you have any queries in index investing, please post in comments. I will be happy to respond. If you like this video, please hit the like button and share this video and subscribe to our channel for more videos. Thank you.